Welcome to my channel Investor Facts. Make sure to click on subscribe, like and comment. The US economy is currently in a recession, and the same is true of Europe and China, leading to a global recession. Prices are dropping, and we believe deflation is a bigger risk than the feared inflation. Our opinion that deflation can be a beneficial thing, if it is caused by progress, has been challenged. It is now clear that the greater risk is deflation, but we don't think it is necessarily bad. Growth is likely to be scarce this year, but innovation can help solve some of the problems we are facing. Crypto had its worst quarter since 2011, indicating that despite its maturity, the boom and bust cycle is still in effect. The S&P 500 and Nasdaq are both down 20 to 30% year to date, further painting a grim picture. The stock market has been brutal this year, with the worst year-to-date performance since 1962. The bond market has seen its worst performance since 1788, over 250 years ago. However, the Federal Reserve is beginning to receive signals from the economy that suggest a recession is in the near future. Companies are likely to confirm this in their upcoming earnings reports, which could cause the Fed to take action. Therefore, there is light at the end of the tunnel, and investors should remain optimistic. Despite the challenges, the market will eventually recover, and it is important to stay the course. He reiterated what he said in Jackson Hole, that the Federal Reserve is now focusing solely on prices. He believes that the reason for this pivot is due to the tremendous deflationary pressure in the economy. Commodities, gold, copper, oil, lumber, and iron ore have all seen significant declines. Additionally, freight rates have been dropping, suggesting that supply chains are loosening. This could indicate a deflationary spiral ahead. Ultimately, he is glad that the Fed is focusing on prices and hopes it will help to stabilize the economy. So we have deflation in the system, and the way I see it, it's similar to what Paul Volcker did in the early 1980s. He took a sledgehammer to inflation because it had been entrenched in the system after 15 years of reckless spending. Wars, the Great Society, and the move off the gold exchange standard all contributed to this. I believe that Chairman Powell also thinks he needs a sledgehammer, but we don't think that's true. We see evidence of deflation, and a different approach is needed. Furthermore, we are seeing a substantial increase in unsold goods across the globe. Europe is in recession, China is effectively in recession, and in the US, stores are stocked with an excess of goods that need to be sold at a discounted price. We anticipate that these conditions will result in a notable decrease in inflation within the next 3 to 6 months. The PCE deflator, which reached its highest point in February at 5.3%, has since dropped to 4.6%, and it is expected to continue to decline. Therefore, we must be prepared for the potential of further downside surprises. Many people are skeptical about the recent negative economic data, but we believe it's only the beginning. Over the next 3 to 6 months, I wouldn't be surprised to see the numbers dip even lower, possibly even below the 2-handle mark. If the numbers keep declining, the Fed will likely have to reconsider their current stance and make a drastic change. The Fed will be closely monitoring the numbers, which in all likelihood will continue to be negative. If this trend continues, we could be facing a much different economic landscape in the near future. I think their outlook is about to change, and we anticipate that profits will be severely affected until some of these cost reductions are implemented and inventories are cleared. We do not believe this will be anything like the financial crisis of 2008-2009. We believe this is more of an inventory recession, with Europe struggling with energy prices and China adjusting to their new economic reality. There's been a lot of denial that we are currently in a recession. However, we believe we are, and that we will begin to recover next year. Whereas many forecasters are predicting a better year ahead, we believe that the labor market is not as strong as it appears. The employment numbers may appear to be strong. However, when you look deeper, the household employment has been flat for the last 4 to 5 months, which includes a lot of small businesses that have been hit hard by the economic downturn. Right now, The labor hoarding is because companies were unable to source labor during the supply shock and COVID. Now that they can, they are taking longer than expected to let go of employees. I don't think the unemployment rate will reach 6%. The inventory recession will be sharp, and the unemployment rate will go up, but I would be surprised to see it go all the way to 6%. Many growth strategies, including our own, have been adversely affected by the fear of inflation and higher interest rates. As we've discussed, we are confident that these 5 innovation platforms will continue to experience exponential growth. Despite certain market challenges posed by the COVID-19 pandemic, the explosive growth of these platforms is undeniable. We specialize in disruptive innovation and are confident that this trend will continue in the global public equity markets. The impact of these 5 platforms on the global public equity market will be immense. We expect the value of the market to more than double in the next 8 to 10 years, from roughly $8 trillion to over $200 trillion. This is due to the disruptive nature of these platforms, which span 14 different technologies. Never before have we seen such a dramatic shift in the traditional world order. Just like the telephone, electricity, and the automobile did in the early 1900s, these platforms will revolutionize the way we live. We can only imagine the potential that lies ahead. The economy is currently facing inflation, but it is expected to decrease significantly. This will be beneficial to growth. In order to take advantage of this shift, our flagship strategy has been narrowed down from 55 names to 33 names. During the COVID crisis, we experienced a month of hardship. However, we quickly recovered, with a growth of 360 within a year. We now have many deep value stocks to offer, with a 5-year investment time horizon. The 2-year Treasury and the market are both expecting at least 4 interest rate hikes and rising oil prices, which is a burden to lower socio-economic sectors. Consequently, the fear of rising interest rates and higher inflation is being replaced by worries of a potential recession. We hope everything is useful. Don't forget to subscribe to our channel, like the video and share.